Welcome back to my channel on quantitative oil trading. With this episode, we're gonna start a new block of lectures dedicated to volatility trading. Today is gonna be a little bit more introductory, where I'm gonna define some very essential concepts, and we're gonna use the concept that I'm gonna outline today throughout this block of lectures, which again, it's quite essential. Just to remind everybody, nothing here is a financial advice. Everything is for educational purpose only. Uh, if you recall from the first block of lectures on systematic trading, how important it is to understand the behavior of market participants. By and large, what professional traders in the oil space do, they are basically trying to capture imbalances, typically hedging imbalances created by different market participants. The same applies to the options market, but even to the larger degree, because essentially nearly all opportunities in the options market are driven by hedging imbalances. So it's essential to understand, to outline the lay of the land before we get into the trading strategies. So let me try to explain first who are the main participants in the oil options market and what they do. Obviously, we're going to start with the oil producers, and specifically US and Canadian North American oil producers are by far the largest end users, participants in the oil options market. Uh, Many of the producers do hedge their production. They actually don't really want to hedge the production because if you're an oil producer, you tend to be bullish your own industry. You're always bullish the oil prices. However, most of the time you need the money to drill. And if you need the money to drill, you go to the bank and ask for a loan, and the bank is going to force you to buy some sort of a put option to have the basically minimum guarantee that you're going to generate a certain return and you're not going to default on the loan. So a lot of the producer hedging in the oil space is essentially required by lending banks. The problem is, especially if you tend to be if you're a smaller independent producer, you don't have the money to pay for the puts. And the banks came up with a creative solution, essentially. Why don't you sell me the upside? Why don't you sell me a call option that's worth the same amount of money as the put option? In this case, you buy the put, you sell the call, and the net deal is costless, and it's called a costless call or a fence. There is no cash flow. So the bank, as a result, is short the put option on oil and long the call option on oil. Also, sometimes producers do more exotic structures, and we're going to talk a lot about it when we talk about exotics, but they also use other option structures such as three-way instruments where they buy a put spread and sell a call option to finance it. Still costless, but in this case, they buy one put option and essentially sell another put option and call option. So for each one option they buy, they sell two options. So this type of structures result in net selling volatility to the market. So in certain degree, producers can actually hedge their production either by buying volatility when they buy a single option, by being neutral on volatility when they buy one and sell one, or by selling volatility to the market. They can do all three. Naturally, one would expect consumers to take the other side of their exposure. And the largest industry that hedges in the energy exposure is an airline industry. Because for airlines, fuel cost is as important as labor. It's the second largest cost for the airline. So a lot of them really have to do that. However, obviously their exposure is to jet fuel, and they tend to hedge by buying options on refined products, specifically on jet, but the jet market is not the most liquid one. So they often substitute jet by buying options on diesel instead. And also the credit worthiness of the airline industry, especially in US, but in many other regions as well, is not great. So the banks really are reluctant to take credit exposure to the airlines, so they're actually forcing airlines to simply buy a call option. So a lot of the airlines simply buy call options or call spreads on refined products. So dealers, as banks, dealers generally sell these options, call options to airlines at a premium, but on refined products. And at the same time, as I mentioned earlier, dealers buy call options from producers at a relative discount. So that actually creates, this is an example of one interesting opportunity where as a dealer, you would be selling call options on jet fuel or diesel to airlines at a premium. And at the same time, you buy relatively cheap options from oil producers. The challenge, obviously, they're apples and oranges. So you have to manage the residual risk because you're going to be short volatility on refined products and long volatility on crude oil. That's an example of a relative value trade on oil. And then the refineries can come in, or storage companies. So the refineries essentially is an option, is a real option on the spread between refined products and crude oil. So as an owner of a real option, sometimes they participate in trading financial options on the spread as well, whether it's cross-asset spreads such as crack or time spread as well. So by putting three of them together, that actually creates even more interesting strategies for the dealer because essentially you have an option on X, which is crude oil. You have an option on Y, which is option on diesel or refined products. And then you have an option on X minus Y or Y minus X that you can trade with refineries. So by putting all three together, you can create a very interesting correlation type of strategies. And then you got investors. The retail investors tend to buy short-term options because it's very expensive for them to sell options because of the margins. And we're going to discuss it a lot more in the next lecture on gamma trading and the volatility risk premium. Then the quant funds tend to sell it, but also you get some macro investors sometimes buying longer dated options to hedge against inflation, etc. So, and if you're a dealer, you're in between. If you're a dealer, you're in between, you're trying to capture all these little arbitrage opportunities by buying cheaper options on crude oil, for example, selling more expensive options on jet fuel, buying longer term options from producers, selling shorter term options to retail investors, etc. So I'm not going to spend any time describing you what puts and calls are. I assume you know. But generally, options have nonlinear payoff because on case of a call options, if the future is below the strike, payoff zero. If it's above the strike, it's determined by where the futures are. The higher the futures go, the larger the payoff is, which means in order to calculate the value of the option, you need to know the probability of futures reaching all kind of level, not just a single, but all levels above the strikes. So essentially, and then what you do once you know these probabilities, you do the probability weighted sum, you discount it if necessary, and that's your value of the option. And a similar thing for the puts. So in the options case, how do you get those probabilities? That's a tricky one. In the options case, the higher the volatility, the larger the value of the options because you have more uncertainty and the market can, the downside is limited and you have more uncertainty that can generate wider range of payoffs and increases the value of the option. However, the term volatility is very ambiguous. Sometimes I almost think that quants invented this term volatility to make sure that the broader audience doesn't understand it so they can keep their own little niche and keep making money essentially without letting other people to participate in it. I think it's somewhat true. Volatility is not like price. When you talk about oil prices, you know what it is. You look at the screen and it tells you what the price is. When you talk about volatility, you don't know what it is. Volatility can only be defined in the context of a particular model. Different models mean different thing for volatility. There is no uniform definition of volatility. And I'm going to cover three types of volatility today. All are very essential. They're called realized, implied, and local volatility. All three are quite important. And by the way, if you're a politician, for example, for you, volatility means totally different things. For you, volatility means high oil prices. If, for example, oil keeps slowly creeping up to $100, then as a politician, you're going to be shouting all over, oh, oil prices are volatile because they're at $100. In reality, volatility could be very low. So going back to how do you get those probabilities that determine the value of the option? The first person who really put together the option pricing model was a French mathematician, Louis Bachelier. He wrote a beautiful dissertation in 1900 while trying to price an option on the financial markets. I believe he was mostly focusing on French bonds and a little bit of equities as well. So he was the first one who quantitatively described Brownian motion, and he did it 5 years before Einstein. So we can argue whether Einstein knew about his research or not, but the concept of Brownian motion was first described mathematically by an option analyst in 1900. What effectively he did, he assumed the so-called arithmetic Brownian motion. So again, I'm not gonna give you a course on stochastic calculus here, but really briefly. So what that means, the change in a futures price or in the price of a financial assets has two terms. It has a drift term, which is proportional to time, and it has a stochastic term. So the drift term, for example, you can think about some kind of a growth trend. If there is a systematic trend, then the value of the futures is gonna grow according to that trend. If there is no trend, this term is just zero. The second term is stochastic, which basically means just uncertain. So the dz here is a random variable that can be pulled from a normal distribution with a mean of zero and the variance equals to dt. So that's important. The variance equals to dt means the volatility, the square root of variance, is proportional to the square root of time. And the sigma is the coefficient of what he called coefficient of instability. He also developed a lot of interesting sayings, and one was a so-called principle of zero expectations, which pretty much explains in a very ad hoc way that the drift term does not play any role in pricing options. It has been subsequently proven more rigorously by Black-scholes, but for now we could just ignore the drift term. He called it the principle of zero expectations, that all that matters in pricing option is this coefficient of instability. And he actually showed that the value of at the money option, which he called a simple option, grows as a square root of time. And in fact, that very simple property that he developed really became the foundation of the entire field of stochastic calculus. And it was highlighted by Kolmogorov, one of the founders of this field, and his dissertation was specifically highlighted there. He also showed he provided the link between the probabilities and physics. So he showed that the probability density function, the very famous bell-shaped normal distribution, this is the one here on the right, it actually satisfies the Fourier heat equation, and he was the first one to derive it. And this Fourier heat equation is also subsequently became known as the Black-scholes equation. Sorry for that longer introduction, but he deserves all the credit. And interesting enough, that his formula, which is based on a normal price distribution, is still used by oil option traders today. which is absolutely remarkable. So if you ever want to read one quantitative paper on any asset, I would strongly suggest to read his dissertation. It's not the easiest read, but it's absolutely fascinating. And then the second development in the option pricing model was the Black-scholes model, where basically they couldn't really deal with the normal distribution because normal distribution allows prices to go negative. So the equity prices really couldn't go negative. So the Black-scholes and Merton, they assumed the log normal assumption. In the log normal assumption, which is geometric Brownian motion, the change in futures price is basically proportional again, there are two terms. There is a drift term and the volatility. And the volatility here is proportional to the futures price. And the coefficient of proportionality, that's what's typically known as the Black-scholes volatility, and it's measured in percent. So whenever you see the reference to like 30% volatility, that's usually the number. But you see volatility here and there mean different things. So in a geometric Brownian motion, volatility is measured in percent. In the arithmetic Brownian motion, volatility measured in dollar per barrel per unit of time. And one of the important contributions of Black-scholes, they proved mathematically that options can be replicated by dynamically trading their underlying stock or futures. And as a consequence of that, they also derived and they proved that the drift term is irrelevant. You can just throw it away. And we just focus on this volatility. So you have this two arithmetic and geometric Brownian motion as a stochastic processes. So each one corresponds to a certain probability distribution. As I already mentioned, the arithmetic Brownian motion corresponds to the normal curve, which is you see this curve in blue. It's a Gaussian bell-shaped curve, and the log normal one is skewed. It's going to be very important for pricing options with different strikes because a log normal distribution is bounded by zero. It has a much thinner left tail, but a fatter right tail. But what happened? These two assumption, arithmetic and geometric Brownian motion, are only two special cases of the broader class of stochastic processes, which we call diffusion. And bear with me, I need to set up this mathematical foundation before we get into more practical concepts, because as I said, we're going to use them as a reference throughout the course. So the world is realistically neither normal nor log normal. The real oil price distributions are much more complicated than this too. So the idea here is to describe the stochastic process in a little bit broader sense and let this volatility to be a function of time and also a function of the underlying futures. This function is unknown. So this is the function that really describes the core. It's the engine that drives the futures market. We don't know what it is, but we'll just give it a name for now. We'll call it a local volatility function, and we'll show how we can estimate this. So let's assume the whole market is driven by this. The change in futures price is characterized by a certain term dz, which we pulled from the random as a random variable, and it's scaled by this local volatility function. In a special case, if your local volatility function is constant, then your underlying distribution is normal. And if your local volatility function is proportional to futures, then your underlying distribution is log normal. You can think about it, dz is kind of the source of risk. It's a random variable, but this local volatility function is a quantity of risk. And there are different ways to measure that quantity of risk. Again, you can use you can easily measure it in percent, how the Black-scholes did, or you can measure it in dollar per barrel, how Bachelier did. Oh, he didn't do it for oil, but you can measure it in dollars. Okay, that's a bit of a longer, kind of deeper slide, but again, we're going to refer to that throughout the course, not just today. Now, let's go to kind of a couple of more simple concept of volatility realized and implied. So the realized volatility in the oil market It's essentially mathematically is defined as a standard, typically defined as a standard deviation, annualized standard deviation of the historical price returns. So it's kind of tied to the Black-scholes framework here, where volatility is measured in percent and everything. So first we calculate the returns, which are quite ambiguous, to be honest, in the futures business. But again, it was designed for the equities, where everything is measured in percentage returns. And then you calculate standard deviation over a certain historical look-back period, and we annualize it and that's your realized volatility. So effectively, the realized volatility is only a single realization, a single realization from history of this unknown stochastic process with a certain local volatility which we don't know. All we can observe from the history is one path. It's just one trajectory. Obviously, there is not a whole lot you can really learn from observing one single trajectory in the history. That's why the realized volatility is popular among sort of non-professional traders because it's all they can estimate easily, but it's not particularly helpful for pricing and hedging options. So it has all kind of issues. It's extremely sensitive to the choice of the look-back period because the realized volatility computed over 60, 30, 60, 90, 100 days, they all are going to be different numbers. So which one are you going to pick? Typically, what people sometimes do, so if you're pricing an option with 60 days to expiry, you tend to look at 60 days realized volatility in the past. But it's very tricky because the realized volatility, as I said, is highly sensitive to the choice of the look back period. Perhaps one way to illustrate it simpler. Uh, Here I plotted the realized volatility around COVID and to illustrate the so-called ghost effect. So you can see the blue line here is the 30-day realized volatility. So realized volatility spiked around COVID and it stayed high for exactly 30 days because after 30 days, this couple of volatile data points simply dropped out of sample and the volatility dropped. So if you apply the same thing to 6 months realized volatility, you see it's in orange. The volatility spiked and then it stayed high for exactly 6 months and then it dropped. So you have this, and it's similar for 1 year volatility in gray. The realized volatility spiked and stayed high for 1 year and then it dropped. So you have this volatility ghost. So in other words, for 30 days, this ghost is going to be chasing you for exactly 30 days. And on day 31, it's just going to drop. Obviously, the short-term volatility is much noisier than the longer-term volatility, which causes another problem, like which one do you really choose for pricing options? So if you choose the short-term, it's going to be highly volatile. If you choose a long-term, it's going to be less relevant to current market conditions. Another problem with realized volatility, you can see here in the graph on the right, it's extremely and artificially negatively correlated to prices. So here, for example, I shaded in gray a few periods of what I call oil busts. So one is like where oil dropped by a lot. You see oil prices in blue here. So oil dropped a lot in 2008 around financial crisis, and then 14 when OPEC increased production and then during COVID. In all of these cases, volatility measured in percent jumped. It's a bit artificial, and I think the better way to illustrate it to do the same graph in the form of a scatter plot. So here it's the same graph, but here I showed the futures on the horizontal axis and realized volatility on the vertical axis. So you can see the realized volatility goes to artificially high level when the futures price are low. It has nothing really to do with the market. So it's simply the artificial feature of the log normality. Because when your prices are low, so you're trying to calculate the percentage returns. when you calculated the percentage returns, remember volatility, the realized volatility is the standard deviation of percentage returns. So when you do the returns and the price is low, you're dividing by the very low number. So the lower the price are, the more volatile the returns are going to be. So that's what you're seeing here. If your price are lower, your volatility is going to astronomical level. And in particular, when the price approaches zero, your volatility, realized volatility is going to go to infinity. And if your price is negative, you can't even compute it. So the Black-scholes, the whole realized volatility measured in percent, it just doesn't really work in oil. So it basically not really telling you anything particularly useful. So it's a simply highly inversely correlated to price. When people say, oh, volatility is going to be high when the price is low, but yeah, that's just an algebra. So it really doesn't tell you about the real price fluctuations. That's why the oil prices tend to measure volatility sort of in a bachelier term. They still sometimes measure the realized volatility to get some sense of a history, but they measure realized volatility in dollar per barrel per unit of time. So in this case, if you measure realized volatility as a standard deviation of price changes, not returns, the picture becomes much more symmetric. So for example, you see here the range around, let's say the oil price is 60, the volatility tends to be fairly stable and actually fairly low in dollar per barrel. But when you move away from this kind of fundamental normal range, either in either direction, either towards lower prices or higher prices, then the volatility started to pick up. So for example, here, if the oil price like between 60 and 50 and $40, again, the dollar per barrel volatility tends to be similar, while the dollar per barrel volatility is going to increase if we drop to like 20 or if it go to 100. That's very different from the artificially skewed log normal volatility. And again, it's going to become essential when we trade the volatility smile. And volatility smile, so let me first define the implied volatility. Okay, so you got the realized one. It's a single realization of the historical past. It's a backward-looking statistics. It's one realization of this unknown local volatility function. So the implied volatility means totally different thing. In fact, comparing the two, one shouldn't really do it without referencing a specific model. So implied volatility essentially is an artificial plug into incorrect pricing model to match the market price. So if you take a Black-scholes model, it has one parameter, volatility. And if you're going to try to match different market prices, you're not going to be able to match market prices of options with all strikes at the same time. Because different volatility is needed to match option prices with different strikes, which means the Black-scholes itself is not an adequate model, because if the Black-scholes were right, then the same volatility would be sufficient to explain option prices with all strikes, but it doesn't. So to visualize that effect, what option traders do, they calculate different plugs for options with different strikes to simply make sure their model matches the market price. So the model is incorrect. So you basically need to tweak the model to make sure it still matches the market price. So, and if you plot this kind of implied, this is called implied volatility. So you always assume as a trader, the market's generally right. So there is a trade-off. Do you assume your model is right or the market is right? Generally, we assume the market is right and your model is wrong. Then you try to tweak the model to match the market. So that's a way to tweak the model. So if you plot those implied volatilities for different strikes, here I listed the strike here, and this is your implied Black-scholes volatility. It's going to look like, it's not like really a smile. The term smile originated in FX where the curve was a bit more symmetric. In the oil space, it's negatively skewed. It's negatively sloped. So it's more like a skew. So it's a bit more pronounced for shorter term options, which is here shown in blue. It retains his negative skewness for longer term options. So it becomes more like almost like linearly decreasing for longer term options. And also the short-term options has more convexity. You see it kind of curves on both sides. It curves more on the puts than on the calls. And again, this is similar effect to this because when you remember when I said when the futures price are low, you need higher percentage volatility. The same thing here. When your strike is lower, you need higher percentage volatility to match the market price. So those are your kind of volatility skews. And again, volatility smiles doesn't tell you anything about the richness of the options. It's a common misperception. Sometimes people think, oh, the skew is to the put, therefore puts are more expensive. That's totally wrong. The volatility smile simply tells you the Black-scholes model is wrong. And what it's telling you how wrong it is. So if the Black-scholes were right and one volatility would match all option prices with all strikes, the smile didn't exist, would have not existed. It would have been a straight line. So the presence of the smile just shows you how wrong the model is. The further away the smile is from the straight line, the less correct the model is. So the model is less correct on a put than it is less correct on a call. The model is more wrong on the puts. And the reason it's more wrong on the puts, it effectively goes back to this thing, because the Black-scholes model uses log-normal distribution. And the log-normal distribution, you see, it has a very, very thin left tail and a relatively fat right tail. So it just doesn't have enough probabilities here on the left, comparing even to the normal distribution or to the distribution, the actual that describes the market that may even have fat tails. So the problem, that's the artifact of the log normal model. It just doesn't have enough probability mass on the left. So because it's a wrong distribution, so we have to basically tweak that distribution by sticking a larger input into the distribution. Essentially, we widen it artificially. The distribution itself doesn't have the probability mass. So we're trying to make it wider by sticking in artificially large volatility. So again, this doesn't tell you anything about the value of the puts. It simply displays, it shows you essentially the values of different options in kind of what I say different coordinate system. So you can think about it. A good analogy would be trading bonds, where there are a lot of bonds with different prices, but they're very difficult to compare against each other. So we tend to compare bonds in terms of yields. So here is a little similar. So we basically we measure the prices of options in terms of implied volatilities because it's just an easier to standardize. And sometimes we simply use Black-scholes implied volatility as a measure of our option price. So this option can trade at 80% volatility. This option trades at 60% volatility. But again, it doesn't mean that the other one option is more expensive than the other one. It simply means your underlying assumption is wrong. So you can also do implied normal or implied Bashelier volatility. And this is what professional oil traders do. The amateur traders tend to use implied black volatilities measured in percent. The professional oil traders use implied normal volatilities, which essentially taken the Bachelier formula now based on the normal distribution based on this. And again, sticking essentially different volatilities into different strikes and then plotting them versus strikes. So here I actually plotted versus a moneyness because I use the actual historical data to do that. So if you look at the historical implied smile for Black-scholes, for black smiles and Bachelier smiles, the black smiles is very skewed. It's in blue. And again, here I use theoretical example. This is actual volatility calculated over the last like 20 years. And the orange one is a Bachelier smile. The key point here, the Bachelier smile is much more symmetric and it's more intuitive. So it's a little bit similar to the realized volatility graph, where volatility is low when the oil price is in the normal range, and when the volatility tends to pick up when oil moves in either direction. The same thing here happens on implied volatility. So the implied Bachelier smile looks a bit more parabolic. It tends to be low around at the money level, but then you need higher volatility for out of the money options because at the end of the day, the Bachelier model is still based on a normal distribution, which is Gaussian curve. The actual distribution has fat tails, so it actually has a much higher probability of extreme events than either normal or log normal. So you need to compensate for that by sticking in essentially a higher volatility to the Bachelier model to match the market price. We're going to talk a lot more about that when we discuss smile strategies. But for now, the key takeaway here, the smile could be measured in log normal and normal terms. The normal smile is more intuitive, is more symmetric. It has a bit of a parabolic shape, and this is what professional volatility traders use. And then another concept here is a volatility term structure. So here you plot implied volatility. You can do the same thing for realized, but I'll do it for the implied. So the implied volatility is a function of time to maturity. So generally, volatility decreases for longer maturities, and it's higher for shorter maturities. This is something that's called Samuelson effect. The Paul Samuelson is the first American Nobel Prize winner, and he wrote first about it in the context of realized volatility, and then the concept was generalized to implied. But basic idea, the way how you can kind of think about it, maybe starting with the futures price. So the futures price themselves are driven by essentially two sources of uncertainty. You can think about the spot oil price. You can decompose it as a long-term futures price F, as a spread, front to back spread S minus F. So the long-term futures price is not very volatile. It's generally, so the long-term price is not very volatile. It's generally driven by the marginal cost of production and a little bit of hedging pressure, which we both going to discuss in detail later. But the spread between spot and futures is more driven by the inventories. So it's highly volatile. So there is a lot of uncertainty because the inventory is really the net result of the short-term imbalances between supply and demand. It's highly volatile. So there is a lot of volatility in the futures around the option expiration. The closer you get to expiration, generally the higher the volatility is. And then as you go further down, the volatility decreases, and partially it's driven by storage. Because what storage does, it essentially buys you time for supply and demand to normalize. So it's effectively functioning as kind of a buffer, decreasing volatility over time. So the volatility curve term structure could be actually humped, which is a gray curve. And we can talk next week, in the next lecture, that the front end of the curve tends to be tied more to realized volatility via gamma strategies, but the hump could be caused by the simultaneous low realized volatilities and some upward hedging pressure from, for example, producers buying volatility in the market. Or volatility could also go fairly extreme. If you got a geopolitical event, or you got a hurricane, or the pipeline froze, and the volatility could spike in the front end, and then the term structure steepens. So in the final slide for today, and again, I'll probably come back to that slide, but it's more like the layout here for the next few lectures. So this is how you basically construct your professional oil volatility trading portfolio. I generally kind of have 6 different sub-portfolios. Gamma trading essentially trades very short-term options, and we're gonna cover it next. It's a volatility risk premium, and the concept of gamma is extremely important. It's probably one of the most powerful driver of actually futures prices. Then we're gonna talk about Vega and Smile arbitrage that I alluded to earlier today. We're gonna talk about the term structure and some average price options because most of the options in that the end users trade over the counter average price. Gonna hopefully talk about cross product like jet volatility versus oil volatility. Then hopefully get into correlation trading, some exotics. I'll do it into pieces. So my plan is to cover the gamma trading next, and then we'll probably talk about Vega trading, and then depending on your feedback, we'll just decide what to do next. A little bit longer lecture today, but as you can see, there are quite a few of really important concepts to define. We probably going to refer to that lecture a few times in the future. But again, the key takeaway: don't kind of stick with your traditional percentage-based Black-scholes volatility that sometimes you read in the news. It doesn't tell you a whole lot, and we'll talk more about this. Volatility measured in dollar per barrel was much more meaningful. Again, don't pay too much attention to realized volatility. It's not particularly helpful. You need to compute more implied volatilities, but you have to do it smarter. And again, the smile doesn't really tell you anything about how rich or cheap the options are. What tells you how cheap they are is the gamma trading. And the gamma trading is what we're going to cover next. I'm looking forward. It's going to be really an interesting lecture, I hope. Thanks for listening. Subscribe to my channel. There is more to come, and leave me the feedback. Thank you very much, guys, and go.